Hey guys, what's up? I'm Gabe, and we are here today with a very special guest, Ryan Brandenburger with Cross Country Mortgage. We've worked with him and known him a very long time. He's an expert in the mortgage field. So, have a couple of really important things to discuss today related to some issues that we've run into with clients in the past. But first, Ryan would love for you to take the floor and give a little bit of information about you, your company, and what you specialize in.
Great. Appreciate that. Thanks, Gabe. So my name is Ryan Brandenburger. I'm the branch manager at Cross Country Mortgage here in South Florida. I also have locations in Tampa and in Buffalo, New York. It's my hometown. So I have been in the mortgage business now. This will be my 19th year. I started out as a mortgage broker, worked my way into being in 16 different states, suffered the crash. I was part of that, went into a little bit of the loan modification business while staying true to the mortgage business. And here I am still standing 20 years later. I've never really pivoted from mortgages. So, in South Florida, I'm one of the top producers. I'm the top 0.01% in the country. I currently have a staff of 70 individuals in our Boca Raton office. And we specialize in originating traditional home loans like conventional FHA, VA, and we also do a lot of different like non-QM stuff for bank statement programs, investor-friendly loans, and I'm here to give any insight that I possibly can for you guys.
That's awesome. So it sounds like basically you've got all angles covered where a lot of people in the mortgage business have one little thing that they do. You've carved out multiple niches in the field, it sounds like.
Yeah, over time, it's in my role, it's bring me your problems and I will come up with some solutions, right? So over time, just so many different scenarios that I've came across, whether it's individuals looking to buy, refinance, people that are in hardship, that are dealing with, pre-foreclosure, foreclosure. They may have bankruptcy issues. We just kind of come together and try to solve their, everything that's on the table. Even if it comes to credit restoration, we do that in-house as an extension of service for the mortgage business.
That's actually, yeah, that's great. That's actually what we're here to talk about today. Alex, I'd love for you to kick it off here.
Yes.
So you're on the front lines with a lot of our customers, and specifically with people in the foreclosure situation. Why don't you ask Ryan a little bit about what you run into and what people's options are when they run into these issues?
Of course. Yes. Thank you so much, Ryan, by the way, for the time.
Thanks.
So a big issue we run into a lot when we're talking to a family. They're trying to go through the process of let's say inheriting a property that had a reverse mortgage on it, right? And they're looking at their options. They don't have $300,000 in cash to pay off this reverse mortgage, but they don't want to sell the property. And it's gotten to a point where now some type of auction's been set. It's now going into foreclosure, and they'll tell me, hey, what we're going to do is we're going to get the property refinanced. It's going to pay off the reverse mortgage. Everything's going to be great. And that does sound good, but a lot of the times I end up seeing that property ended up going to foreclosure, or they couldn't get the problem solved. So on your end, a property, somebody comes to you, it's at pre-foreclosure already. There was a reverse mortgage. What are their options, and kind of what are the hurdles in getting a property like that refinanced?
Oh yeah. So with the reverse mortgage, you have an allotted time. I believe it's 12 months from the time of death from the initial borrower to resolve that issue. So if it's left to a surviving spouse, they're more lenient on allowing you to stay in that property in the reverse mortgage. But when it comes to let's say one of the children being willed the property, they have to get something done within that amount of time. And if they don't, HUD, who manages all of our, manages all the reverse mortgages, they will start the foreclosure process. So I think it's important to get a head start on that and don't wait until the 11th hour, because once that foreclosure process starts, they're going to start incurring fees. And whether it's the filing of, the lis pendens, and notice of default, all of that stuff comes with additional cost, and it adds up very quickly. The interest is continuing to accrue. So as much as it's not coming out of pocket, it's going to come out of their bottom line. So the best thing they can do is get in touch with a mortgage professional right away, someone like myself, and I can kind of dissect the situation. Once the property is deeded to the individual, the seasoning starts, right? So let's say, for example, if somebody was to pass today and in the will it said that their son or daughter were to receive that property. Typically, there's a waiting period when doing a refinance. That waiting period is waived if, in fact, it's in a will. So they can refinance immediately after the passing of someone. And that process starts with a traditional pre-qualification. So what we always want to do first is try to go for the gold, right? So the gold standard in mortgages is going to be conventional financing. Or if it's a larger loan, it's going to be jumbo financing, but that's in that elite status where you're going to get the best interest rate and the best terms. Now, traditionally, the person who's taking the property is not taking it back as their primary. They're usually taking it back in some form as an investment property or a second home. So you would follow the traditional guidelines with Fannie Mae and Freddie Mac, which are conventional lenders, to try to take that property over and put it into what we would call a forward mortgage, which is what a traditional mortgage is. And so we would take that on. If, in fact, they could not qualify for traditional financing through showing income, credit, and assets that Fannie Mae requires, there are other programs out there that could allow them to take that property. There's debt service loans where if there's enough equity in the property and the rental income would justify the purchase, you could do what's called a debt service loan. But anytime you come off of that gold standard, that conventional financing, you're going to start seeing a difference in terms, right? So Fannie Mae financing, lower interest rates. You start getting into debt service loans, the interest rates get much higher. Outside of the debt service loan, there's also bank statement programs, which are becoming very popular. They're popular among our self-employed individuals. So if somebody has, say, a landscaping business and they have 12 months of bank statements showing $200,000 in deposits, they can use the bank statement program to acquire that property. But I think time is of the essence when it comes to this. It's a get a head start on it now before the fees start to accrue.
So time is of the essence, and if you're in a good position financially, credit-wise, then you don't have much to worry about it. It seems like it should be pretty straightforward to get it refinanced if you're in a good position yourself already.
Yeah, it's equity driven as well, right? So if the property is worth 300 and you owe 350, a lot of times at that point, which we don't see as often, just to be clear, we don't see that as often in today's market as we've had such great appreciation over the last few years. But if you run into a problem where you're upside down, you can elect to not even take that property back, and you can give that property back to HUD. HUD writes that off as a loss. That does not go back down to the person who inherited the property. So a lot of times you can kind of do the keys back and walk away from that property.
That's great.
Yeah, that's awesome. And then you mentioned as well, Alex, we were speaking earlier with regard to people saying that they're trying to work things out. They're trying to figure out, if they can talk to the bank. Somebody's the owner of a property, it's not inherited, they're in foreclosure, that whole thing.
Correct. So let's say it's not an inherited property. It's a property you own yourself, and an auction's been set. The foreclosure's been started. If you could, I know it's never as simple as a percentage or chances or things like that, but what are the realistic chances of you getting that loan refinanced? And what are your options there?
So whether or not you can qualify for the refinance is just going to get back to your traditional standards of income, credit, and assets. And then most importantly, equity. So if the equity position is there, right, and you're at 80% or lower loan to value in it's going to be, you're going to check that box. Equity is right. And then it comes down to income and credit. Assets are not as important because you're acquiring a property. You're not usually putting any money into it. But let's look at a hypothetical scenario where if you owe $300,000 and it's worth $300,000, well, and you want to take that property back, you want it, and for whatever reason, you could still refinance. You would have to bring the difference to the table to bring that down to the loan to value that's required by today's lending standard.
So essentially, you just have to make that 20% down payment all
Correct.
over
If
again
it's
to
a
get that.
second,
Okay.
so a second home, you can maximum loan to value is 90%. An investment property is technically 85%, but the rates are pretty bad. So call it 20% equity for a investment property, 10% equity for a second home. But if it's a primary, let's just say, for example, the person was going to take the property back and they were going to live in it as their primary. Maybe they were renters before, they're relocating. They can in fact get a loan up to 95% loan to value. Yeah, those cases are pretty slim though, because most people who inherit a property most of the time the children or whoever's taking it over, they're already in a position, they're not looking to move into that home. And as you guys have probably noticed, a lot of times those homes are not up to date, right? If somebody had a reverse mortgage on it, they weren't, the last thing you're worried about at that time in your life is new kitchen cabinets and granite countertops. So the properties are, you might be pulling out a shag rug, and they usually need a lot of work. And it's difficult. If your loved one passed in Florida and you're living in New York, taking back that property is more difficult than people would think, because what it takes to have to rehabilitate it to put it back to market.
Right, you're almost taking on a second job at that point with trying to take over a project like that.
Well, I think you guys know the rehab business better than I do, but I'm in the process of doing one right now, and it is it's not my line of work for sure. I'm learning that quickly.
And so Ryan, when you talk about looking at equity, credit, income, and assets, so somebody who is facing foreclosure, because we deal with a lot of individuals who are facing foreclosure, and you're right, because there is some equity in the property, given the fact that the markets have been on a tear recently. Somebody has the equity, somebody has the income. They may not have the credit because now they're in a foreclosure situation. Can that even be refinanced at that point?
Great question. Unfortunately, once you've gone into 90 days late, you're pretty much cut out of conventional FHA and VA financing. So then who's really left at that point? Non-QM lenders, and the terms are usually unfavorable. And I look at it like this. If you had a hard time paying your mortgage at 4.5%, I don't think an 8% loan is going to band-aid that problem. I think all you're going to do is add to it, and eventually you're going to be right back in the same position. But the difference is this next lender is not going to follow. See, Fannie Mae and Freddie Mac are government regulated lending institutions, right? FHA, VA, obviously being managed by HUD. Their terms, their foreclosure process is a little bit more lenient. But once you go to these non-QM lenders, they're not afraid to take your property very quickly if you in fact make a mistake that second time around. So I look at it, if you have enough equity that you can get from underneath it and start rebuilding whatever it was that created the problem in the first place, whether it's your income was the problem why you weren't making a payment, or maybe you had a loss of a loved one, whatever caused that financial strain, the solution is not getting back into another loan that has worse terms than the first loan that you defaulted on. Most of the time, you end up right back to where you started with the first foreclosure process, except now you're talking about adding on a considerable amount of expenses on top of that.
And to that point, as it relates to the credit piece, you mentioned something that stuck out to me, 90 days late. If you were to compare the effects on your credit over the span of 10 years, whether you look at 90 days late versus having a property get sold at auction, can you discuss how a lender reviews that? Are they both just as bad, or is one worse than the other?
Well, once the lis pendens is filed, it's a pre-foreclosure. It's bad. I mean, you're gonna, you're not borrowing a lease for the next 12 months. So if the lis pendens is filed, your traditional lending sources are gone. At 90 days, you could still find someone out there that we have these like I said, aggressive investors with unfavorable terms, they will entertain that 90-day. But you have to really show that whatever it was that caused the hardship is behind you. So if in fact, there was a loss of employment and now you can show that you have your employment back, I mean, you could argue that case. But if you're in the same situation that got you into the foreclosure, at the time that you're trying to refinance, there's nobody out there ready to take that loan on. It is time to figure out an exit strategy that's gonna create the least amount of loss.
Even if the bank is made completely whole.
So if the bank's made whole, you can hold. Okay, so that would not involve refinancing, right? So that would be renegotiating with your existing lender. So you can go back in, and they're not as 8 years ago. Well, now I guess it's been 10 years when we had a lot of stimulus designed to help our homeowners with the equity problems. Those are kind of gone. So they do have, you can call your lender today and ask for forbearance agreements. You can ask for your loan balances to be tacked on to the end of the loan and renegotiate. But they also want to make sure that you're not going to get back into the same problem. So they will do a light underwrite, but you can negotiate with your current lender. But at that point, you could have to hire an attorney to help with that process, or you'll work with the loss mitigation department at any of the lenders, and they'll do their best that they can to solve that problem. And if they do, and you get back into a rut again, they're less likely to help the second time around because they know that they're just setting you back up for failure.
Now, you mentioned a whole bunch of these different things that somebody can do with their current lender to sort of reinstate a mortgage that's fallen behind, whether it's deferring principal or something. We encounter a lot of people where they're facing foreclosure. They have an auction date that is, let's say, 30 days away, 15 days away, and they say, "Oh, we're working with the lender. They've promised us that that there are documents in the mail that they're going to send us. All we have to do is sign those, and then we're good." And we've seen it. Unfortunately, it's terrible. Where I think some of these lenders will string them along, and just to get them to not fight the foreclosure, and then we'll go back and we'll look at the property and it sells at auction. Meanwhile, these people were putting all of their trust in the lender to follow through on some sort of a modification. So have you seen that, or are you familiar with that, where the lenders drag things out for that purpose?
They do, and the challenge is the person who is handling the process of modification is not the decision maker, right? So their job is to kind of give you a sense of hope, because that's how they have a job, right? Their job is to be there and help customers work through it. But ultimately, your scenario is going to end up in the hands of a decision maker. And that's not the person that's telling you, yes, send this in, we'll go for the modification. And when it gets to them, they're going to look at the big picture. And if they don't feel that a modification is going to get you back to a good standing, then it could get denied. And like you said, you could have lost a lot of time in between that, where you're continuing to accrue interest. And next thing you know, it's kind of too late to prepare, because you put your eggs in one basket with having this modification come through. And the whole time you could have been working something out with a multitude of other options, whether it's you could hire an attorney and try to litigate, but that usually just postpones the inevitable as well. But you could look at alternatives where, you could sell your property in this market. There's plenty of people. It doesn't matter about the condition of the property. There's always somebody that's ready to give you top dollar in today's market.
Cool.
And one more scenario for you that I see kind of regularly that just came to mind too. So I'll see somebody who has a property that they may have code enforcement liens, back due property taxes, issues like that start to stack up, and those create some type of auction that gets set. And I talk to a lot of people that say their plan to handle those are to refinance, take out some money against the house, and get those liens or those encumbrances paid. What's that process like? Is that something you guys do specifically? If someone comes to you with that issue, I suppose, what are your thoughts, and what do they need to do next?
Well, it's a good question. It all depends who's leaning the property and whether they're lenient or not, right? No pun intended there. But
Yeah.
if it's the IRS, there's no leniency in liens, right? So I have a situation right now, and the guy has it's like an $80,000 IRS lien. So we're trying to get them to take second position, because remember, the IRS goes right into first position. Right. So we're saying, can you take second position so we can refinance this loan? And they say, no, pay it off first. You can get the IRS to agree to it, but you have to pay them first. It's almost impossible to do. But we've done it. We've sent in all the paperwork. We showed there was enough equity. We got the refinance and paid the lien off. IRS is the most difficult lien. If it comes to other liens, second mortgages, mechanic liens, city or code enforcement liens,
Child support liens.
Yeah, I mean, you got to get all parties together to agree, and not everybody is as open as others. I mean, it's going to be really deal specific. But yes, you can refinance if you have a lien, but you have to get it. You have to get the creditor or the person who's liening your property to agree to whatever it is that you're trying to accomplish.
Got it.
That's great, man. That's I think that's really helpful. It's definitely a lot of stuff there that's going to help clarify things, because I think a lot of the times customers are getting strung along by other sources with a hope and a dream of something happening. And to Eitan's point, I cannot remember ever seeing a time where somebody said, we're working it out. No, thank you for offering for your help, but we've got this figured out. And then we look back, because we always look to see what ended up happening, and they lose it. They lose the property. And I just, the thought of them getting pulled out by the sheriff onto the front yard with nowhere to go is a sad thought.
Yeah.
I'm sorry, go ahead.
Yeah, I was going to say, once you go into default, you're going to get a lot of people that are swimming around. You got attorneys sending you letters, you have investors sending you letters, and it can be overwhelming, right? You're trying to do a modification. You got some mortgage broker in your ear telling you he can do a refinance, but he's not understanding the guidelines. So you just become so confused, and whatever it was that got you into this predicament is probably still going on in your life as well. So when you add all of those things up, it's really hard to say what is the right decision. It's not like you can call an attorney and really get an attorney's best advice, because their advice may be about their best interests, which could be prolonging. During the collapse in 2008, there were attorneys that were charging customers. They were targeting customers that were in default and saying, hey, don't pay your mortgage. Give me $1,000 a month, right? So they used to have a $2,500 mortgage. Now they're saying, the attorneys were saying, give us $1,000 a month, and we will go ahead and hold off whoever's coming after you for this foreclosure. And they thought they were getting away with something. Like, hey, I got to keep my house, and I'm only paying $1,000 a month. This is the best deal ever. But the problem was, on the balance sheet, when it came to their payoff, they were accruing additional fines and fees and illegal fees. And next thing you know, all their equity, it's equity stripping. Their equity is being stripped by the legal processes, accrued interest. And one day the music stops, and now you have to deal with the problem. Personally, I think it's best that if you're in an equity position where you can walk away from your home, unscathed as much as possible, right? No foreclosure on your record is so important. If you have a foreclosure on your record, you're out of the market for 3 years for FHA, you're out of the market for 7 years for conventional, and 2 years for VA. And then forget it. With VA loans, if you go into foreclosure, the VA will ding your entitlement. You may not see 100% financing in a VA loan for years after. So it's sometimes best to really look at the situation and say, it's like the bird in hand or two in the bush, right? If you can walk away and put some money in your pocket and get yourself back in line without going through a foreclosure process, you can get back into homeownership in 12 months. If you don't have a foreclosure, you can buy again. If let's say you're 120 days late and you sell that property prior to it going any further, you can go and buy a home in 12 months. You let that go a little bit longer and you're going to start a 3-year waiting period with FHA.
Wow.
Yeah. Well, Ryan, thank you so much. Does anybody else have any last questions here? Can we wrap it up?
No question. Just wanted to say thank you, because like what Ryan said, you end up getting so much information. You don't know what's right, what's wrong. It's all conflicting, contradicting itself. So it's nice to hear from someone who's done thousands of mortgages, just direct answers on what exactly does happen. So that was great. Thank you so much.
It's refreshing.
And I appreciate it, guys.
Yeah,
Thanks for inviting me.
And what we've heard a million times from customers is that they're getting all kinds of different information, but here with Ryan on the front lines handling, how many mortgages did your company do last year, roughly?
Well, the entire company, Cross Country Mortgage, we did about 150,000 mortgages. I personally did 1,200 in South Florida.
Yeah, so I think you know what you're doing.
No marketing either. It's all referrals. And you know why? You just got to shoot it straight. You got to tell people the right answer. And during the refinance boom, people would call me and I'd say, no, it's not a good idea. And they'd say, yeah, but the last mortgage guy I talked to said it was a good idea. And I said, because it is a good idea for him. See, you got to really be conscious of, whose interest, the people that you're talking to really truly have. Yeah. And, that's why it's always good to work with people that you trust and, or somebody that you get, that you can, somebody that was referred to you, somebody that that's got some credentials. So if anyone wants to look up my credentials, they can see me online. I'm all over Zillow. I get great reviews and may not always have the answer that you want to hear, but at least it'll be a truthful one.
Well, I can say I worked directly with Ryan on the mortgage for my property. And the thing that stood out to me the most was the efficiency and communication was incredible. Like your operation runs like a well-oiled machine. Everybody was Johnny on the spot, always hearing back from people. If I reached out, somebody would answer the phone. And, when you're trying to get something done, that's everything. Everybody can claim this and this and that and to add on top of it, for what most people, it would be the most important thing would be the fees. They were by far the lowest. But what was most important to me was being able to get somebody on the phone or getting a quick response by email. And I gave your operation 5 stars across the board. So
I appreciate that, Gabe. The whole trick to that is I tell people I don't make a lot of money on every loan. I just do a lot of loans. And somebody taught me that about 8 years ago. He goes, don't count the commission. You don't count the volume. Count how many people you can help every day and count the units. And also, I had to learn, you got to spread out the revenue on a loan to your employees so they work just as hard as you do, and I'm just really blessed to have a great team. And everybody they just, they're paid well, they work well, and they all have the most important thing I look for in this business, and that's passion. And that's a passion to help people. And I've been really blessed.
Awesome. Well, for everyone watching, none of this is legal advice. This is all based on our own experiences. And combined, we all have a lot of experience with these types of situations. In the description all of Ryan's contact information along with his website. And if you are not in a situation or perhaps depending on where you are in the foreclosure situation, definitely feel free to reach out to Ryan directly. And we thank you very much.
Appreciate it, guys. Thanks so much.
All right. Thank you, Ryan.
All right, we'll talk soon. Thanks.